exchange-traded funds, or ETFs, continue to come into the market. To make sense of these new products, I'm joined by Morningstar's Alex Pronaeus. Alex, welcome.
Thanks, Christine. Good to be here.
Alex, we've had a number of big-name fund managers with new ETFs, and now a major bank, ANZ, has come into the market. What are the drivers behind this trend?
I guess the key driver of any product launch is to gather assets, and the ETF market has been doing well more generally in that regard. It's been growing at about 50% per annum for the last few years. That's going to be the key driver behind any product launch. But underneath that, why are investors favouring ETFs? Why are they attracted to ETFs? It appears that they're attracted to features like the low cost, the transparency, the tax efficiency, and the ease of execution. And we've even seen some active managers recognise the appeal of the listed structure with some new listed investment company launches from the likes of PM Capital and Investors Mutual, and even a listed managed fund launch from Magellan. What's important to remember though is that there are benefits to the listed structure, but there are also some drawbacks, and that not every strategy will offer all the benefits. So you really need to drill down to the individual product and the strategy to understand what you're getting.
Alex, some of the products like the Market Vector Small Cap ETF and Beta Shares First Nasdaq ETF seem to be quite niche products. So what are the portfolio implications?
We'd typically suggest most investors would construct a portfolio with a bias to products that broadly represent the large asset classes, so Australian shares, global equities and bonds. There is room for smaller allocations to some of these more niche products or satellite holdings. In the case of small cap Australian equities, that's typically an area where our best ratings have been reserved for active managers. They have been able to pick winners within the sector and, more importantly, avoid the losers. So whether it be unprofitable mining stocks during the mining boom or speculative tech companies back in the tech boom, they have been successful at that. In the case of something like the Nasdaq product, what you've got to remember there is that you may already have some exposure to that through your global equity portfolio. So for example, two of the biggest global equity managers in Australia, Magellan and Platinum, they already have or have held at times exposure to stocks like Intel, eBay, Microsoft, which are Nasdaq stocks. But Beta Shares product does present a useful tool for investors who may want a shorter term allocation, or who may want to time their entry in or out of the technology or the Nasdaq area, or for investors who want a more targeted exposure for a lower cost than an active fund.
Alex, Vanguard has now announced that it will add China A shares to its emerging markets ETF. Firstly, what are China A shares? And again, what are the implications for investors?
Yeah, China A shares are essentially Chinese companies listed on either the Shenzhen or Shanghai exchange. So historically, foreign investors couldn't invest directly in China. They could invest via companies listed in Hong Kong. So Vanguard's product, for example, has about 28% exposure to China through companies listed in Hong Kong. So MSCI, one of the biggest index providers, has basically announced that they plan to include A shares in their index methodology, recognising the fact that foreign investors are increasingly being allowed to invest directly into A shares. So what does that mean for portfolios? Well, you've already got about a 28% exposure within, say, the Vanguard Emerging Markets ETF. You've got 28% exposure to China. With the addition of A shares, you'll get another 6% exposure. So it's significant, but it's not a huge change in strategy. What it does mean is a little bit more diversified exposure to China, because you have some companies that are further down the market cap spectrum. and also a lot more access to the faster growth within China. Whether or not that's good or bad growth is debatable. There's been about 100 IPOs in China just in the first 4 or 5 months of 2015. There has also been quite a run-up in share prices in A shares. The market has doubled over about a 12-month period. So for long-term investors, it's probably not a huge change that's going to affect your strategy. But for shorter-term investors, they may want to consider some of the finer details there as far as what that means for their investment decision.
Alex, you touched upon it earlier, but again, what are the factors that investors need to look at when assessing these new ETFs?
The key factor for a passive index tracking ETF is what is the asset class and what is the benchmark or index used by the ETF to represent that asset class. So we'd want to understand how that asset class and how that particular index exposure fits within a portfolio. So once we're happy with that, then we'd look at the capabilities of the ETF provider and the product. So do they have the appropriate people in place, the systems, the governance structures? And lastly, indexing is a very competitive space, so it's not rocket science that if you've got 2 ETFs that are fairly similar, tracking the same index, it's not rocket science that you'd probably pick the cheaper one.
Alex, thanks again for your insights.
Thanks, Christine.